Namaskar friends, welcome to the channel JIB and CIB Made Simple. Today we are going to discuss our IIBF Certified Treasury Professional memory based question which was asked in the examination which happened on 11th October 2025, and I will provide you detailed explanation of all this question. All the question which I am providing with you have been collected from the memory based of the students who have appeared in the examination. So through this question you can see the most important topic, and also let me tell you that I have compiled several kinds of videos based on memory based question. The link of those video I am providing in the description section of this particular video. You can go through them and you can also get to know that which are the most important topic. So let's get started with our first question that we have. That we will understand a very important concept from foreign exchange, that is so called NOOP, right? That is called net overnight open position. Don't worry, by the end of this question you will understand it the simplest way possible. So the question is, which of the following statement correctly describe the NOOP limits applicable to the bank? Let's go through option by option. Option A say NOOP limit is fixed by RBI and apply only to onshore exposure of the Indian bank. Option B say NOOP limit is the maximum amount of foreign exchange exposure a bank can keep overnight and should not exceed 25% of the bank total capital. Option C say NOOP limit include only derivative transaction such as forward and option excluding a spot transaction. Option D say NOOP limit do not apply to offshore branches of Indian bank. So we have to answer that. First of all, option number A. So this statement sounds partly correct but is actually wrong. Why? Because RBI gives guideline. Remember what RBI does, RBI gives guideline. Okay. But each bank board decide its own NOOP limits within the RBI overall cap. So cap is provided by the RBI, and the board of bank, they decide, right? That every board decide its own NOOP. Also, NOOP apply to both onshore. Remember, it apply to both onshore as well as offshore exposure, right? So the bank has to consider its total foreign exchange exposure both inside and outside India. So let me give you one example. Let's suppose SBI has a branch in India, right? That is called onshore, and it also has a branch in Singapore, right? So that is called offshore. Both branches deal in dollar, right? So the total USD exposure in India plus Singapore together count toward the NOOP limit. So why? That's why option number A is right. Is wrong, partially wrong, because it says that fixed by RBI. No, this is wrong, because fixed by the, actually RBI gives a cap, but actually it is fixed by the on bank board management and apply only to the onshore operation. This is completely wrong. What about option B? Option B says, see, this statement is correct. Why? Because here are some keywords. The first word is overnight. Here you can see the word overnight they have written. So what is the meaning of this one word overnight? Let me explain here. So overnight means position the bank carry when the forex market get closed. That is called overnight position. That means position that the bank carry when the forex market get closed. Then you will see the word NOOP limits. What does it mean? It means it ensures that bank don't take excessive currency risk. Yes, so that's why this NOOP limits is there. NOOP limit is there to ensure that bank do not carry excessive currency risk, because currency value can fluctuate when market will reopen. When market will reopen, currency value will fluctuate continuously. And one more point they have written, the limit cannot exceed 25% of the bank total capital. Yes, this is also correct, right? It's like safety limit to make sure that bank don't bet too heavily on currency movement overnight. So all these three terms are very good, are correct. So first of all, it is overnight, which means the position that the bank carry when the forex market is closed. Second thing is NOOP limit, which ensure that bank don't take excessive currency risk, and the limit cannot be more than 25% of the bank total capital. Yes, it is wholly correct. Option number B is completely correct. What about C? C option says that NOOP limits include only derivative transaction. This is wrong. This is incorrect. Let me highlight it. This option number C is incorrect. Why it is incorrect? Because if I tell you that NOOP limits cover all kind of foreign exchange transaction. Remember, it cover all kinds of forex transaction, whether it is spot, whether it is forward, right, or whether it is derivative, right? So everything get covered. Because whether it is forward contract or a simple currency purchase, it all adds to the bank total exposure, right? So you can think of NWP as the total foreign currency balance that the bank is holding. It does not matter how it got that exposure. What it is saying, it includes only derivative transaction. No, that's why it is wrong. What about option D? It says that it does not apply to offshore branch. Again, it is wrong. I told you now. And NWP does apply to offshore branch. However, offshore exposure are not netted off against the onshore exposure. Remember, this is the very important thing. Some people think that, there are some offshore exposure, and there are some onshore exposure. But, netting off is not done. They are not netted off, right? This means that offshore exposure is seen separately, but the total of both the onshore and offshore exposure must stay within the limit. So let me give you one example. Suppose there is a bank named ABC Bank. Okay, it has $10 million in India. Okay, in India, and suppose it has $5 million in its Dubai branch. Okay, so the total exposure is how much? Total exposure is $15 million. Right, both count toward NWP. So both of them will count toward net overnight limit. Net, right? So I told you the full form of NWP. You remember it? Right, net overnight open position. Both of them will count toward the NWP. Right. So that's why the correct answer to this question is option number B. So what we learned from this question, let me just summarize you. So I told you that. So friends, what we learned that, this NWP is just like it is just like a safety cap, right? On how much foreign currency exposure a bank can hold overnight. It protects the bank from losses due to currency rate change, right? It protects the bank from losses due to currency rate changes when market are closed. Now, it is set by the bank board. I told you now, it is set by the bank board and it cannot exceed 25% of total capital, right? And now, it applies to, sorry for my handwriting, but I am telling you, it applies to both onshore and offshore, branches. And it includes all the kinds of Forex transaction, whether it is spot, forward, derivative, etc. So the next time someone asks you what NWP limit means, just say it's like a nighttime safety lock on how much currency risk a bank can carry. That's it, right? I hope this is crystal clear. So friends, please hit the like button. And if you want a study material for CTP, then you can check our course on which is available on my JIB and CIB Made Simple app. The link is provided in the description section. You can see the content. We have theory and MCQ PDF which cover the entire syllabus. Previous year question already three PDF I have added, and this one will be fourth one, right? And also I have added capsule content which contain module wise quick revision notes, module A, module B, C to E, F and G. So through this course, many aspirants have cracked the paper, right? And also we are offering 10% discount. For more detail, you can WhatsApp me on this particular number. Let me show you the number. So now let's move to the next question that we have, which is regarding FRA. So please note down the number if you want. If you have any query related to this CTP, you can WhatsApp me on this particular number. So the second question is, which of the following statement about FRA is correct? FRA, forward rate agreement, right? Sounds technical, right? Don't worry. By the end of this slide, you will understand in plain English what it means, how it works, how to remember it easily. So option number A says that, FRA settled periodically through multiple interest payment over the contract duration, similar to an IRS. Option B say, FRA is a forward contract to fix the interest rate for a single future interest period, with settlement occurring at the start of that period based on the difference between the agreed fixed rate and actual floating reference rate. Option C say, the floating reference rate in an FRA is determined at the end of the interest period and interest settlement occur 1 month after the period end. And option D say, FRA rates are derived solely from the current spot interest rate without any reference to yield curve or swap market data. These are the 4 options that we have, right? So now let's go through each and every option. Option number A. Let's see option number A. Option number A says that FRA settles periodically through multiple interest payment. See, this statement is incorrect. Why it is incorrect? Because, in an IRS, see, basically, it is saying that it's similar to IRS. No, that's why it is wrong. Because, if we talk about interest rate swap, right? If you compare with the IRS, let me just give you a glimpse of IRS. In IRS, there are multiple payment. Remember, in the case of IRS, there are multiple payment. And it's like, exchanging fixed and floating interest payment every few months. So what you do in IRS, you exchange fixed and floating payment, right? Fixed and floating interest payment every few months, right? Over several years. That is what we do in IRS, right? We exchange floating interest payment and fixed interest payment every few months over several years. but FRA is just for one single future period. This FRA is just for one single future period, right? Which means one rate, one settlement. That's it, nothing of that. You can think of it like this way. If IRS is like a series of EMI that you pay every month, but FRA is like a one-time payment for one future only, for one future period only, one-time payment. That's it. So FRA and swap are not equal. It is much simpler and shorter, right? So that's why option number A is wrong. It says that multiple interest payment. No, that's wrong. Option number B, yes. See, FRA, this statement is absolutely correct. Let's make it simple. What is FRA? Let me explain what is FRA. FRA is basically like a deal. FRA is basically a deal to lock your interest rate today. You lock your interest rate today, right, for a future period. For example, suppose that that 6 months later, right, you will take a loan for 3 months. That after 6 months, right, after 6 months you will take a loan for how many days? To 3 months. Fine. You are worried. What if interest rate rises by then? So today what you do? You sign an FRA to fix that future interest rate. Your motive is to fix future interest rate. That is your motive, right? So when that 6 month period arrives, right? So suppose the market rate goes up. What will happen? You gain. Why? Because you already locked. Since you already locked it earlier, at a lower rate, so obviously you have gained, right? But suppose market rate goes down. Suppose the market rate goes down. What happened? You lose. Why you lose? Because you fixed at a higher rate, obviously, right? So settlement happened. So I hope this makes sense, right? And the second point they have mentioned that settlement occurring at the start of that period based on the difference between the agreed fixed rate. See, settlement happened at the start of the loan period, not at the end. So yes, this is correct. And only the difference between the fixed rate and the market rate is exchanged. So no actual loss, no actual deposit changes hand. Only the interest difference is settled. Yes, this is absolutely correct. What about option C? Option C says that the floating reference rate is determined at the end of the interest period. Remember, in FRA, this floating reference rate is determined just before the period start. Typically 1 or 2 days before. And settlement happened at the beginning of the period. I just told you, settlement happened after the beginning, not when it ends. So it's like agreeing today about what interest you will pay next season, not waiting till the end to decide, right? What about option D? Option D is also incorrect because FRA rates are usually derived from yield curve. Remember, it is derived from where? It is derived from yield curve, right? Basically, especially the government security yield curve. Yes, GSEC. If we talk about the GSEC yield curve. So remember, FRA rate are derived from government security yield curve. In more developed market, FRA rate are linked to swap, right? They are linked to swap market data because swap market reflect the real time expectation of the future interest rate. So a spot rate is not enough. It is saying that a spot rate, this is not enough, right? That's why this is wrong. So remember what we learned. Correct answer is option number B. What is the key learning from this question? Let me just summarize for you. So what I told you that whenever you see this word FRA, think about it like a deal. Deal for what? Deal for fixing a future interest rate. Deal for fixing a future interest rate, right? That is a deal. Second thing, what it covers? It covers only future. It covers only future interest period. It covers only future interest period. Second point. Third point, settlement. When settlement happened? So remember, settlement happened at the start of that future period. Settlement always happened at the start. And what is the basis of payment? So I told you the basis of payment is the difference. Difference between what? Difference between the agreed rate and actual market rate. So difference between the agreed rate and actual market rate is the basis for payment, right? So remember, again I am telling you, so next point is that reference rate. So reference rate is decided before the interest period begin, right? Before interest period begin, reference rate is decided, and rate comes from yield, right? Yield curve or swap market data. So remember, FRA means you fix rate in advance for one period, right? So next time someone asks you what is FRA, you can confidently say, it is a one-time deal to fix your future interest rate today and settle the difference when that period starts. That's it. I hope this is crystal clear. Now friends, have pen, paper and copy and just solve these MCQs, right? Just solve these MCQs. And one more thing I want to tell you, that this is the convention of showing the FRA 6 into 12 FRA, which means that the period start in the 6 month, right? This notation, sometimes question they ask in the form of this notation 6 into 12 FRA, right? So which means it will start 6 months and it will go till next 6 months. That is the point, right? Now have a look at this question. Please solve this question. Very, very important, right? So the question is asking you that basically treasury bill are issued at the discount and redeemed at face value, right? If 91-day T-bill is priced as 99.26, what is the implicit annualized yield rounded to decimal? So let's first happen what is happening with the T-bill. See what is happening here. Let's understand what this question is all about. Let me explain here. So friends, what is happening here, that you buy a T-bill below 100. You bought a, just wait a minute. You bought a T-bill below rupees 100, right? At a discount, obviously. And the government pay you 100 when it mature. So government pay how much? Government pay 100 at maturity. Is it clear? Now the difference is your earning, right? Difference is your what? Difference is your earning, your return or your yield. So here in this case, what is the T-bill price? What is the treasury bill price? Treasury bill price they have given you, I think 99.26, as you can see, right? Treasury bill price they have given you 99.26, right? And what is the face value? Face value they have given 100 rupees. You can see face value they have given 100 rupees, right? So how much is your gain? Obviously, so your gain is 100 minus 99.26, which is equal to 0.74 rupees per treasury bill. What the question is asking, what is the implicit annualized yield, right? Now this bill maturing in 91 days, right? So we will analyze it using the formula. There is a formula that you need to remember for analyzation. What's the formula? So see, this is the formula. Yield is equal to 100 minus price, which is your gain, upon price multiplied by 365 upon days, right? That's the formula, right? So now in this case, what is our 100 minus price, which is 0.74, right? 0.74 divided by 99.26 multiplied by 365 by days. How many days are there? So I think days they have 91 days, right? They have mentioned it, 91 days. So that would be near about 2.99%, right? Or we can say 3%. So that is how you find the annualized yield. And this question is the most important question. They ask every time, right? So the implicit annualized yield is 2.99%, or we can call it 3%, right? So, so basically in short, treasury bill gives you profit though discount, right? Through discount, not interest. And this profit is expressed as annualized yield. I request you to please remember this formula. This will be asked most frequently. Now have a look at the next question. Question number 2, again, see, there was a case study which was asked based on the treasury bill, and that is what I am presenting before you. So the question they ask you, which of the following statement about the auction participation in treasury bill is correct? Option A, only bank and primary dealer can participate in T-bill auction. Option B, retail investor can bid competitively but cannot participate via non-competitive bidding. Option C, non-competitive bidding for treasury bill is open to state government, designated foreign central bank, provident fund, a special entity. And option number D, non-competitive bidding allotment count within the notified amount of the T-bill issue. So tell me which one is correct. So friends, see, there are two ways to participate in treasury bill auction. What are the two ways? The first way to participate is, let me just change the color. Yes, the first way is, competitive bidding. What happened here? That participant quote their price. Participant, what they do? They quote their price or they quote their yield, right, in the competitive bidding. And the second kind is non-competitive bidding. What happened here? That participant just apply. Participant just apply and RBI give them allotment. RBI give them allotment at the average price. RBI allot them at the average price, which is decided in the auction, right? So that is what is happening in the NCB. That is called non-competitive bidding. So competitive bidding, what happened? That participant quote their price, participant quote their yield. But in the non-competitive bidding, participant just apply and RBI give them allotment, and RBI give them allotment at the average price decided in the auction. So that's the difference. Okay. So now let's look at the option. So if you see the option number C, yes, it explained it correctly. Option number A is wrong because not just bank and primary dealer, even individual can also invest. It is saying that only bank and primary dealer. No. Individual can also invest. What about option B? it says that retail investor can bid competitively but cannot. No. This is also wrong. Because retail investor cannot bid competitively. They must go via NCB route. Retail investor, for them, competitive bidding is not allowed. What about option C? Yes, this one is the correct one. Because non-competitive bidding is allowed for a state government, designated central bank, provident fund, specialized entity. Correct. Even retail investor can invest this way, but they have a 5% limit of the total amount issued. Right? This is a very, very important. So a small investor can also buy treasury bill easily through the non-competitive bidding. Competitive bidding is not available. I hope this is crystal clear. What about option D? Option D is wrong because it says that non-competitive bidding counts within the notified amount. No, they are outside the notified amount. They are not counted within the notified amount. So remember, what we learned from this question is that very, very important point. Please remember it. Retail. If you are a retail investor, you can go through non-competitive route up to 5%. Up to limit is 5%. So this question may be asked in the upcoming examination. I hope it is crystal clear. Right. Very good. Now friends, let's look at the third part of the question. Again, based on the treasury bill. The question is asking you, when is the auction issued of 182 days treasury bill? So the question is, when is the auction issued? When is the auction? What is the auction schedule? Auction schedule they have been asking of 182 days treasury bill issued by the government of India. So options are weekly every Wednesday. Option B, fortnightly on Wednesday preceding a non-reporting Friday. Option C, fortnightly on Wednesday preceding a reporting Friday. Option D, monthly on the last Wednesday of the month. So I think you know it very well that treasury bill are issued for either 91 days, 182 days, 364 days, right? And each has its own auction schedule. This one has a schedule, which is this one has a schedule, and also this one has a schedule. And who decides the schedule? This is decided by the RBI. So if we talk about this 182 days treasury bill, the auction happen every 2 weeks, right? Auction happen every 2 weeks, and that is what we call, so this every 2 weeks is what we call fortnight. This every 2 weeks is what we call fortnight. Or on Wednesday, just before a non-see, auction happen every 2 weeks on fortnight, right? And it is usually Wednesday, right? Just before a non-reporting Friday. So the question is, why such kind of timing? Because non-reporting Friday are weak when bank don't have to submit balance sheet data. So liquidity is smooth, making it good time for auctioning the midterm bill, right? So, they are reporting Friday, non-reporting Friday. Non-reporting Friday are those week where bank don't have to submit the balance sheet data. So liquidity is smooth and making it good time for auctioning the midterm bill, right? That's why non-reporting Friday. So let's look at the option that we have. So option number A says that weekly every Wednesday, again wrong. Because this weekly apply to 91 days bill, not to 182 days bill. See, I am telling you some other fact also. This fact may come in the examination, in the upcoming examination. So please make sure that you understand each and everything. What about option B? Yes, this one is correct one. What about option C? It is again wrong. Because it says that reporting Friday. No, not a reporting Friday, but non-reporting Friday. Right. And option D is wrong because treasury bill are not monthly. It's saying monthly. No. They are not monthly. They are fortnightly. So remember what we have just discussed. Let me just summarize regarding the treasury bill. This may help you in the upcoming examination. So think about treasury bill like this. Remember, they are issued at a discount, right? And they are redeemed at the face value. Second point, their yield formula, please remember 100 minus P upon P into 365 upon days. This will give you the annualized yield, right? So I hope this is clear. Auction, two types of auction, competitive and non-competitive. Right, retail investor are allowed. Yes, the retail investor are allowed, but limit is non-competitive route only. They are not allowed through competitive. They are allowed through non-competitive route only, and the limit is 5%. 5% limit. Right, and the last point I just discussed that 182 days treasury bill. Remember, right? They are auctioned. Auction happen fortnightly. Right, on Wednesday before a non-reporting Friday. That is how treasury bill works. Simple, safe, and super important for understanding the money market. Now friends, have a look at the next numerical question. Please try to solve on your own. So this question is asking that investor is considering a mutual fund with an expected annual return of 14%. The risk-free rate they have given is 5%. The standard deviation they have given is 9%. What is the Sharpe ratio? So now we are going to understand one of the most common ratio used to measure investment performance, right? You know about this Sharpe ratio? Basically, this is one of the most common ratio, right? This is one of the most common ratio that we use to measure the investment performance. That's called the Sharpe ratio. Don't worry, If it sounds technical, by the end of this slide, you will know exactly what it means. So investor is considering a mutual fund. Expected annual return they have given, as you can see, 14%, and risk-free rate is given 5%. The standard deviation of the mutual fund return is 9%, as you can see. So Sharpe ratio have been asked. First of all, what is the meaning of this Sharpe ratio? Let me explain. What is the meaning of this Sharpe ratio? So basically, when I say Sharpe ratio, it means, that it measures how much extra return. It measures how much extra return you get for every 1 unit. For every 1 unit of risk you take. Means how many extra return you get for every 1 unit of risk that you take. Right. So simple idea is that the higher the Sharpe ratio, the better your investment return compared to the risk you're taking. See, it is nothing but return upon risk. See, if the Sharpe ratio is higher, it simply means, return will be higher per unit of risk. Is it clear? So what is the formula for Sharpe ratio? It's very simple. So what we do, please remember it, please note it down. Return of portfolio minus risk-free rate, that is the premium, risk-free rate, and divided by standard deviation. Just wait a minute. The standard deviation, that's the formula, right? Now tell me, what is the return of the portfolio here they have given you? As you can see, return they have given 14%. Just write 14%. What is the risk-free rate? 5%. Right. And what is the standard deviation? 9%. That's it. Just plug the number. Okay. So that will give you 1. Just see, it will give you 1. So answer will be option number A. Now let's interpret it. What does it indicate? So option number A is correct. That's what our calculation gives. It means that, our mutual fund give 1 unit of extra return for each unit of risk taken. Pretty balanced, right? Not too risky, not too inefficient. Okay. And rest option are incorrect. See, let me explain using one example. Right. Let me explain using one example. So friends, you can think of it like this. Imagine that there are two mutual funds, right? Imagine that there are two mutual funds. So this is the mutual fund number A. Its return is 14%. This is the return, right? And risk is suppose 9%. And this is mutual fund number B. The return is 11% and risk is 4%. Now both earn above the risk-free rate, right? Both earn above the risk-free rate, but which one give better return for the risk? That is exactly what Sharpe ratio to help you see. If fund A has a Sharpe ratio of 1% and fund B has a Sharpe ratio of 1.5%, then fund B is more efficient because it gives higher return per unit of risk. Okay. So see, Sharpe ratio can be less than 1, can be greater than 1 or equal to 1, or it can be 1 to 2. So if it is less than 1, what it means, it is below average. It means it is below average, not great return for the risk, right? If it is between, if it is 1, exactly 1, it means it is good. It is fair balance of return and risk. If it is 1 to 2, it means very good, right? Very good, which means efficient performance. And if it is greater than 2, that means excellent, top performing fund is there, right? So remember what we learned from this question is that Sharpe ratio formula, just remember it, return of portfolio minus risk-free rate upon standard deviation. In the book, nowhere it is written, right? That's the peculiarity of this session. I explain you each and everything so that from the nutshell, if you have don't any idea, you can understand it from the basic, from the, from scratch. Okay. So it measures the return earned per unit of risk, right? And, greater the Sharpe ratio, better the performance. And if it is 1, then it is a balanced investment. If it is greater than 1.5, it means very efficient fund. I hope this is crystal clear right now. Now friends, have a look at this next question that we have. This question is all about, DVP. That is called, delivery versus payment. So the question is, which of the following statement correctly describe the DVP settlement method in security transaction? Yes. So basically, what are the options? That DVP ensured that securities are delivered only after funds have been fully transferred, eliminating principal risk by synchronizing the delivery of security with payment. Option B, DVP allows security to be delivered before payment is made, relying on trustworthiness of the transaction party. DVP and RVP, that is called receive versus payment, refers to two unrelated settlement systems used only in different countries. Option D, in DVP Model 3, securities are settled individually on a gross basis without multilateral netting of fund. Let's look at option number A. What do you think about option number A? Yes, this is the correct one. Why this is the correct one? Think about it. Imagine that you are buying a share worth rupees 1 lakh. Let me explain. Let me explain what DVP is all about using the simplest example possible so that you can memorize it for the lifetime. See, imagine that this is you. This is you. And you are buying a share. What you are buying? You are buying a share. How much? Worth 1 lakh. Fine. You don't want to send the money unless you are sure that you will receive those share, right? You don't want to send the money unless you are sure that you will receive those share, right? Obviously, you don't want to send the money unless you are sure that you will receive those share. And the seller also don't want to give away the share unless they are sure that they will get paid. Obviously, both side want, right? So DVP makes sure that both happen at the same time. Like suppose this is the seller, this is you, and this is the seller. So what happens through DVP? You know that you pay and you receive share. You make the payment and you receive the share, right? So this way no one gets cheated. That is why we call DVP remove the principal risk. Here you will see the word they have written, eliminating the principal risk. What does it mean? It means, you know, no one loses out if the other party default, right? DVP ensure that it eliminates the principal risk. Suppose if any party default, no one loses out, right? That's the peculiarity of this DVP. Yes, this is the correct one. What about option B? It says that it allows security to be delivered before payment. No. Because if only one party deliver first without getting money, it is quite risky. Actually, you know, this delivery versus payment was actually created to avoid exactly this kind of trust-based system. Earlier, this was a trust-based system. To avoid such kind of system, this DVP came into picture. It ensured no delivery before payment. Simple as that. What about option C? It says that DVP and RVP refers to two unrelated settlement. In fact, you know, DVP and RVP are two sides of the same coin. दो एक सिक्के के दो पहलू हैं ये, right? From the buyer point of view, think about it. Please understand. See, from the buyer point of view, like you are the buyer, right? Please understand. From the buyer point of view, you know that if DVP is DVP, I will deliver money when I will receive security. What I will say that yes, I will deliver money. I will deliver you the dollar when I will receive security. Who say this? Buyer say this. Yes, I will deliver the dollar when I receive security. When this is from buyer point of view. What is from seller point of view? He says it is RVP. He says that I will receive payment when I will receive payment. I will receive payment when I will deliver security. See, seller has to deliver security. Buyer has to pay money. From buyer point of view, it is DVP. From seller point of view, it is RVP. That's why it is called, you know, two sides of the same coin. So both terms describe the same settlement process, just from the different perspective. Is it clear? Right. So it is in that there refers to two. No. That's completely wrong. What about option D? This is also wrong. If we talk to the context of model number 3, you know, both securities are both securities fund are settled on a net basis, right? They are settled on a net basis, not individually. That means all the transactions between multiple parties are first netted off, and only the final balance is settled. That is called net basis. This save time and this save money also. So in short, we can say, you know, there are three models of DVP, right? Model number 1, model number 2, model number 3. In model number 1, you know, they are settled individually. That is called gross settlement, right? Individual settlement happen. In model number 2, you know, securities settled gross. Securities, they are settled gross, right? And funds, they are settled net. And in the model number 3, you know, both netted multilaterally for efficiency. So 1, 2, and 3. Security model number 1, both are settled individually. Model number 2, securities are settled gross, funds are settled, funds are netted. And in model number 3, you know, both netted multilaterally for efficiency. So remember, the key takeaway from this question is that, you know, DVP means no delivery without payment. No delivery without payment. It eliminates the principal risk, and DVP is from, you know, buyer's point of view, and RVP is for, you know, seller's point of view, right? Model number 3 says that both side netted. So you can think of a DVP like a shopkeeper who say, I will hand over the item only when you pay the bill. That is exactly how the financial market ensures safe settlement between the buyer and the seller, right? Friends, we have more question available. If you want me to explain that also, please write yes in the chat box or in the comment section. I will provide you the part 2 lecture of this video, you know. And if you want such kind of previous year question paper for your understanding, for knowing which topic are super important, you can WhatsApp me on this particular number, or you can join our course. I have provided such kind of PDF where I have provided the question along with proper explanation that will surely help you in easily cracking the examination in the first